The business of insurance is built on trust. Individuals and businesses alike rely on insurance companies to provide financial protection against a multitude of risks. In the United States, the regulation of this vital industry has been a dynamic interplay between state and federal authorities. This complex relationship has evolved over time, shaped by landmark court decisions, congressional acts, and the emergence of key regulatory bodies. Understanding the history of insurance regulation in the US is crucial for grasping the current landscape. This essay delves into the major milestones that have shaped the industry, from the early days of state dominance to the growing role of federal oversight. We will explore the key acts and rulings that have defined this evolution, examining their purpose, outcomes, and impact on the balance between state and federal regulation. By understanding these pivotal moments, we gain valuable insights into the current state of insurance regulation. This knowledge is essential for anyone involved in the insurance industry, from seasoned professionals to those new to its intricacies. The early years of insurance regulation in the US were marked by a distinct lack of federal involvement. Insurance was largely seen as a matter of local concern, with individual states exercising primary authority. This view was solidified in 1868 with the landmark Supreme Court case of Paul v. Virginia. The case centered around Samuel Paul, an insurance agent from Virginia who was selling policies for a New York-based insurance company. Virginia had a law requiring out-of-state insurers to obtain a license to operate within its borders. Paul challenged this law, arguing that insurance transactions across state lines constituted interstate commerce and thus fell under the purview of the federal government. The Supreme Court, however, disagreed. In its ruling, the court declared that insurance was not interstate commerce, but rather a local contract between an insurer and the insured. This decision effectively cemented the role of states as the primary regulators of the insurance industry for decades to come. The impact of Paul v. Virginia was profound. It established a precedent of state-based regulation that would shape the industry for nearly a century. This approach allowed states to tailor insurance laws to their specific needs and fostered a diverse regulatory environment across the nation. The landscape of insurance regulation began to shift in the mid-20th century. The case that marked this turning point was United States vs. Southeastern Underwriters Association in 1944. This landmark decision challenged the long-standing precedent set by Paul v. Virginia and opened the door for greater federal involvement in the industry. The Southeastern Underwriters Association was a group of fire insurance companies that operated in several southern states. The association was accused of engaging in anti-competitive practices, including price fixing and boycotts. The federal government brought suit against the association under the Sherman Antitrust Act, arguing that these practices constituted a restraint of interstate commerce. In a landmark decision, the Supreme Court sided with the government. The court overturned its previous ruling in Paul v. Virginia, declaring that insurance transactions across state lines did indeed constitute interstate commerce. This decision had far-reaching implications, effectively subjecting the insurance industry to federal antitrust laws for the first time. The Southeastern Underwriters' decision sent shockwaves through the insurance industry. It upended decades of established practice and created uncertainty about the future of insurance regulation. States feared losing their regulatory authority, while insurers faced the prospect of increased federal oversight. Section 4. The McCarran-Ferguson Act reaffirming state authority. The insurance industry's response to the Southeastern Underwriters' decision was swift and decisive. Insurers lobbied Congress to clarify the role of state and federal regulation in the wake of the Supreme Court's ruling. This effort culminated in the passage of the McCarran-Ferguson Act in 1945. The McCarran-Ferguson Act, named after its sponsors, Senators Pat McCarran of Nevada and Homer Ferguson of Michigan, aimed to address the uncertainties created by the Southeastern Underwriters decision. The Act affirmed the continued primacy of state regulation in the insurance industry, while also acknowledging the federal government's role in certain areas. The Act's key provisions stated that the business of insurance would be subject to state regulation and taxation. It exempted the industry from federal antitrust laws, but only to the extent that such laws were not specifically related to the business of insurance. This meant that the federal government could still regulate certain aspects of the industry, such as unfair trade practices and consumer protection. The McCarran-Ferguson Act effectively struck a compromise between state and federal interests. It preserved the traditional role of states as the primary regulators of insurance while acknowledging the federal government's authority in certain areas. This dual regulatory system continues to shape the insurance industry to this day. Section 5. Federal involvement grows, from the FTC to the FCRA. Despite the passage of the McCarran-Ferguson Act, the second half of the 20th century saw a gradual increase in federal involvement in insurance regulation. This trend was driven by a number of factors, including the growing complexity of the industry, the increasing mobility of the population, and the rise of consumer protection as a national concern. One of the first instances of this increased federal involvement came in 1958, when the Federal Trade Commission asserted its authority to regulate insurance advertising. The FTC argued that deceptive insurance advertising fell under its jurisdiction, even though the McCarran-Ferguson Act gave states primary regulatory authority over the business of insurance. A year later, in 1959, the Securities and Exchange Commission took a similar step, asserting its jurisdiction over variable annuities. Variable annuities, which combine features of insurance and securities, fell into a grey area of regulation. The SEC's assertion of authority marked another instance of the federal government expanding its reach into the insurance industry. The trend continued in 1970 with the passage of the Fair Credit Reporting Act. The FCRA, which regulates the collection, dissemination, and use of consumer credit information, had significant implications for the insurance industry. Insurers rely heavily on credit information in underwriting and rating policies, making them subject to the FCRA's requirements. Section 6. Modernizing the Industry, USC Sections 1033 and 1034 and the FSMA. The late 20th and early 21st centuries saw further efforts to modernize and streamline the regulation of the insurance industry. These efforts were driven by a desire to improve efficiency, reduce costs, and better protect consumers in an increasingly complex financial marketplace. In 1994, Congress passed Internal Revenue Code Sections 1033 and 1034. These sections provide tax deferral opportunities for certain insurance-related transactions, such as exchanges of life insurance policies and investments in annuities. These provisions aimed to encourage long-term financial planning and provide tax relief for policyholders. A more significant step towards modernization came in 1999 with the passage of the Financial Services Modernization Act, also known as the Gramm-Leach-Bliley Act. The FSMA repealed parts of the Glass-Steagall Act of 1933, which had long separated commercial banking, investment banking, and insurance activities. This repeal allowed for the creation of financial holding companies that could engage in all three activities, leading to greater consolidation and integration within the financial services industry. The FSMA also included provisions aimed at protecting consumer privacy, requiring financial institutions, including insurers, to implement safeguards for protecting sensitive personal information. These legislative and regulatory changes reflected a growing recognition of the interconnectedness of the financial services industry. They also highlighted the ongoing efforts to balance the need for innovation and efficiency with the imperative of consumer protection.